Good morning, let's do it, folks. Welcome to the Streets Opening Bell here from Post 35 on the floor of the New York Stock Exchange on this Thursday morning. Today is the 20th, yes, the 20th of October. I'm JD Durkin. Opening bell rung just moments ago here on the floor by Stillwell Partners and Emerald Holding. Ticker symbol EEX. This in celebration of its final day of advertising week. That's right, Ad Week here in New York. Happy Ad Week to those of you who celebrate. I don't really know if it's a thing you celebrate. With that, let's turn our attention to what is on tap for today. My goodness, if you haven't noticed, there's a little bit of breaking news here in the last hour or so. British Prime Minister Liz Truss has abruptly resigned. We tell you everything you need to know, plus the latest on stocks as well as the bond market with the 10-year hitting a fresh high. We'll also dive into names like Tesla, IBM, AT&T. Probably a little sports talk, but I'll be honest, most of it's probably going to be about Liz Truss, so Martin can help me better understand what exactly is going on. Speaking of Martin, for insights into those stories and so much more, let's now bring in our senior editor, markets correspondent, Martin Baccardax, and honestly, the only man who could probably help me understand what's going on here. Okay, so I'm going to be honest. So here's what I wanted to do in anticipation of this interview with you, is that I know you know the story very well. I don't know the story very well. And I think a lot of people watching, if they're U.S. investors, may not know the story very well. What happened with Liz Truss, Martin?
Oh gosh, how far do we want to go back, JD? Essentially, what we're looking at is the leader of the Conservative Party, who, as a result of the past general election, is also the Prime Minister. Now, what has to be remembered, though, is that she was not elected by the British people. She was chosen as party leader by the faithful members of the Conservative Party itself. They did that over the summertime following the resignation of Boris Johnson. He, of course, had been involved in a number of scandals that basically allowed his position as prime minister to become untenable, despite, it has to be said, his relative popularity amongst the membership. So there's a leadership contest over the summer. Liz Truss wins the day. She becomes prime minister as a result and can command the confidence of the House of Commons, as it's often described. Immediately, she puts forth an economic plan that she says is going to entice growth in the fifth largest economy in the world, largely because it's been moribund as a result of its decision to leave the European Union all the way back in 2016, which has really only become into effect over the past couple of years. As part of that plan, JD, she said she was going to cut the rate of tax on the highest earning people in the United Kingdom, boost borrowing in part to pay it, and to also put a cap on the average energy bill for most UK people heading into the colder winter months as a result of the broader global energy crisis. That triggered enormous reaction in the financial markets because the economy was simply not seen to be strong enough to bear the brunt of the borrowing cost needed to pay for those pledges, particularly when one of the pledges was really something that many people saw as unnecessary, and that's cutting the tax burden of the wealthiest people in the country. So when you put that all together, you had a significant decline in the pound, one of the worst in several decades, which took it to the lowest levels against the US dollar in about 40 years and to near parity. A big spike in government bond yields. That triggered some funny stuff in the pension system, which compelled the Bank of England to step in and control the market turmoil. Absolutely humiliating stuff from top to bottom. And as a result, her position was almost untenable from day two. Essentially, what happened this week, JD, there were two more resignations from her senior cabinet ministers, one of which was the Home Secretary, one of the most powerful positions in the government. And really, once that happened, that was the end of the day. She met with committee members this morning in London. Essentially, they must have told her what she already knew, that her position was impossible. She resigned as a result after just 45 days in office. That's the shortest British Prime Minister tenureship on record, and it beats one that was set back in 1827, JD, when the man in office himself died of a heart attack.
Wow. I mean, my goodness, to try and pick up the pieces on where to take the conversation there. Okay, so you said essentially from day, so is it a surprise to you that it's happening right now, or have you sort of been of the thinking of the last couple of weeks, like, okay, it's just clearly a matter of time here before the new prime minister is forced to step aside?
That's how it's felt, JD. I think right from the beginning, the
Wow.
mandate was incredibly weak because she was never elected by the British people, but more selected by those of the Conservative Party. So straight away, she had to realize that because of the nature of that mandate, she wasn't able to step into the breach as she did with respect to these economic plans, but she cast that doubt aside and basically rolled the dice. by saying to her party faithful, we're going to entice growth by lowering taxes and increasing borrowing. And that just failed spectacularly. So right from the beginning, I think there was concern about the leadership and the tenureship of her as prime minister. The opposition Labour Party is polling incredibly strongly at the moment. And should there be a general election, that would probably put the Conservative Party out of power and then have the Labour Party come in and lead the government. So under those conditions, JD, it's unlikely that party members want to trigger a general election. They want to make sure that they get a leader so that they can stay in office. But that's going to be incredibly difficult because there are so many differing opinions as to who that new leader should be. And it will be difficult then for any new leader to marshal the number of votes needed to pass the first pieces of legislation. If those first pieces of legislation are not passed, then the government collapses and there will be a new general election. I think the assumption is that's probably going to happen between now and the end of the year. But in this leadership contest, if they are to get it right, they may be able to survive heading into 2023. But that's still going to mean disruption in financial markets, at least from a UK perspective. That's probably going to reverberate into Europe and certainly flow back to here in the United States. And we're already seeing evidence of that.
Absolutely. She said, quote, I cannot deliver the mandate on which I was elected. This brings me here largely to my next question. Expected impacts both in the U.S. or abroad or overseas here. And I wonder through the lens of investor sentiment, Martin, maybe there are things that you know to focus on that someone who's watching this broadcast might not even think might be impacted by a story like this. What would you want people to keep in mind as we more officially pivot into the trading session here on Thursday, obviously dealing with pretty notable news with our friends overseas?
Yeah, it's a great question, JD, because there are so many moving parts. But I think the most significant, at least from a US market perspective, at least today, is what we are seeing in the Treasury bond market. And of course, that's the government borrowing costs that are basically changing every day as a result of investor perception over the strength of the broader US economy. What we have noticed over the past couple of weeks is a big jump in borrowing costs for the US government. Benchmark 10-year Treasury notes, which mortgages and everything else in terms of our consumer borrowing are built upon, have spiked to the highest level since 2008. That's a really big move and is really unsettling for a lot of investors because liquidity in that market, which is the biggest in the world, should be able to absorb the new paper that's being issued and the Federal Reserve's sale of government bonds on its balance sheet as part of its overall process to raise interest rates and slow down inflation. So we're getting those big spikes in US Treasury bond yield. That is sending out to some degree concern, not only with respect to the pace of inflation, but the prospects for growth. Very often, or at least for the most part of my career, bond yields have been the precursor for broader market direction because they are so sensitive to broader economic conditions that we see them as being precursors to faster inflation, to slower growth, and to all sorts of other troubling issues in the economy that stocks don't always reflect. So for the longest time, it was best to focus on those as kind of a beacon in the distance. And whilst we are having our nose pressed against the screen for the daily movements in the various stocks that we follow. That's not necessarily the case anymore, simply because price discovery in the bond market is so difficult because central banks are so involved in either buying or selling bonds on any given moment. And of course, now the echoes and reverberations of what's happening in the United Kingdom are affecting price discovery in Europe, in the United States, and indeed in markets in Asia as well. So the confidence that we used to have in terms of what the bond market was telling us simply doesn't exist anymore. And without that beacon, we are now at the bow of the ship and looking into darkness, whereas previously we might have had some light on the subject. So I think that's probably the most concerning condition that we're seeing as a result of these changes in UK politics.
Biggest expectation or thing you'll be looking for in the next, let's even say 72 hours on this story in terms of a reaction from the King, more out of Downing Street, or maybe part of the story the rest of us might not think to follow up on?
The man that she beat out for the leadership contest, JD, is a man named Rishi Sunak. He was the finance minister under Boris Johnson, and he is seen as a pretty steady hand. Now, he has some political baggage as a result of his marriage to the scion of an Indian software billionaire. And I only mentioned that because there were allegations that they weren't paying their fair share of UK taxes, and a great portion of their wealth was held in overseas trusts. That created quite a bit of a stir in UK media last year, rightly so, if you're asking my opinion on that. But nonetheless, he is an intelligent man. He is seen as, again, sort of steady, conservative, and really probably rather cautious with respect to what decisions he would take in a leadership contest, or indeed if he were to become prime minister. So if the Conservative Party is able to get its ducks in a row very quickly and put their support behind somebody who's seen as that steady hand, we may end up coming through this situation, not only from a political point of view, but also from a market point of view, relatively unscathed. But you are correct in pointing out the time frame, because the first few days are going to be critical. If the leadership contest drags on, the chances of a general election simply increase, and ultimately investors have no idea what to expect from a new administration, and that's only going to cause more dislocation that we're already seeing in bond and stock markets around the world.
Yeah, exactly. 45, 44 days here, as you said, a historically short tenure as British Prime Minister. We'll continue to follow where the story goes, of course. And Martin, I'm very personally thankful, because I came into the broadcast saying, I'm not going to even prepare any questions. I'm going to legitimately ask Martin on the spot all the things that I want to know the answers to, because if I want to know the answers, I can promise someone at home does as well. So thank you for answering those. I do want to get a quick check of the markets and then pivot to those markets more specifically, Martin. The S&P right now is down fractionally. Similar story for the NASDAQ. The Dow is up 0.2. Of course, with regards to the major averages, they are up through the first couple of days of this week. We talked yesterday, is this just yet another bear market rally? Not, necessarily having the sustained growth over some time, but, a 1 or 2 day pop. Are you optimistic here the rally can hold, and what are you following in terms of the indexes for today and tomorrow's session?
Today, I think to some degree, we're going to be held down by those weaker than expected earnings from Tesla, but we can talk about that a little bit later. I think at present, what we are seeing is maybe just a bit of caution that reflects what I was describing in US Treasury bond markets, with the big spike in yields, highest levels for benchmark 10-year notes since 2008. And also, GD, I think it has to be remembered, we are looking at the chances of currency market intervention in Japan once again as being hot on the horizon. The Japanese yen is trading at the lowest levels against the US dollar since 1990. A fresh 32-year low was printed in overnight trading at around 150 yen per dollar. Again, typically this isn't something that necessarily markets would focus upon, but what they are concerned about are these dislocating movements, these movements that don't necessarily reflect broader economic strength. And those are the most concerning, because they suggest there's something underneath that we simply don't know. As Donald Rumsfeld might said, these are the unknown unknowns. We don't know what we don't know, and those are the most dangerous. So I think seeing that, seeing the machinations in UK politics, seeing double-digit inflation in Europe, in the United Kingdom, and in many other economies around the world, investors are just not ready to nip at the cheap equity prices that they are seeing, even if they are underpinned by better than expected earnings. So if I were to give that short answer, I'd be satisfied by that, at least for today, and probably heading into the end of the weekly session, because investor sentiment is just as important as the mechanical numbers underneath.
Absolutely. There's no doubt here that stocks are certainly attempting a bit of a bounce back as earnings season continues here. We are expected to hear from some of the major tech companies as well here. Largely, we had the big banks kind of kick things off. To pivot here to tech earnings specifically as we can, what are analysts forecasting, at least as you understand it, and what would your expectation be here, Martin?
I think you're dead right. Next week is going to be probably the most important week in terms of S&P 500 earnings, because we'll get the big tech names along the way. Obviously, it really depends on the kind of companies that we're talking about. If we're looking at tech in a growth perspective, that is going to suffer as a result of the higher Treasury bond yield. And an easy way to think about that, JD, is if you were to ask yourself the question, do I want a dollar today, or do I want a dollar 30 days from now? When interest rates are high, you should almost always take the dollar today, because you can put it to work very quickly, gain interest from it, and then have a greater value dollar in 30 days' time. The reason I mentioned that is because growth stocks in the tech space that sort of promise something further on down the line are less valuable today when interest rates rise, because instead of putting a dollar into a tech stock that will generate earnings in 5 years, you put it into something that's going to generate earnings today. And that's why you see tech stocks slide when interest rates increase. The bigger names, though, like the Apples, like the Amazons, like Microsoft, which are cash generative, tend to perform well in these situations because they are seen as more defensive. So I suspect we'll get strong numbers from those that will buttress the market into next week and beyond. And then everything is at play with the midterms coming in early November.
You know how like in sports we say like you have a favorite sports team, you have a favorite this and that. Obviously, I know you love your Miami Dolphins. Every earnings season, does someone like you have like a favorite earnings call? Do you have a favorite company? They're like, oh, I can't wait for this one earnings call because I love their calls every quarter. Does someone like you have something like that? I would feel like you do.
Yeah, less so the calls, but absolutely the numbers. Apple is the one that I just really can't help but focus on because I just think it's such an indicative company with regards to its supply chain, the sensitivity of that supply chain to the disruptions that we've seen over the past few months, the association it has with consumer spending and consumer sentiment, the associations it has with growth in some of the other large economies around the world, such as China, Europe, and elsewhere, its sensitivity to the strength of the US dollar, and simply ultimately its weight on benchmarks here in the United States being the heaviest for both, the heaviest weight on the S&P 500. And of course, it's simply the most valuable tech company in the world. So Apple is one that I will absolutely pick through at a granular level in order to give myself a better understanding, not only of that company, but where the broader tech space and indeed the American consumer is headed. So absolutely, that's the one that I like the most. I find the call, whilst usually generally optimistic, maybe just a little too helicopterish for my liking. I would like a little bit more dig down, but nonetheless, the company is reasonably transparent with what it tells us about what it saw in the previous quarter and what it sees coming through. So I always enjoy it. But ultimately, I think I probably like the numbers that come out of the release more so than the call itself. But without question, JD, Apple is the stock to watch.
A market cap of higher than $2.3 trillion, but perhaps a little helicopterish, in Martin's word, on the earnings call. I know exactly what you mean there, and I do appreciate that perspective, and thanks for answering a question like that. I do want to talk about bonds here while I have you here. The 10-year T-note, you wrote about this earlier today. That yield hit in a 14-year high, if I'm not mistaken. What type of action, Martin, have we seen with bonds specifically the last week? Obviously, stocks tend to dominate much of the conversation. It's the cool, flashy thing. Maybe from time to time, people want to kind of understand what's happening on the other side. So what should we know here about bonds the last couple of days?
Yeah, I think it's absolutely critical in terms of importance of broader market sentiment, JD. We've seen that spike, which has taken us, I think, if I have my arithmetic correct, about 16 basis points higher over the past 5 to 7 days. Last week, Treasury Secretary Janet Yellen talked about her concerns with respect to liquidity in the broader U.S. Treasury market. That's not something you hear a Treasury Secretary say very often, largely because it's never really the case. It's such a broad market, not only here in the U.S., but indeed around the world. It's probably the principal hedging tool that a lot of investors use, and it's probably one of the most significant tools that people use just for capital preservation in global financial markets. So to have the suggestion that there is a liquidity issue, I think probably didn't get the serious play that it deserved. And since she said that, we've seen the spike up in yields, which of course move inversely to prices. So I do think that is a little bit worrying, although you have to say that it may also simply be the kind of movements expected in the face of a really aggressive plan of Fed rate hikes. And the assumption now, of course, is that we're locked into a 75 basis point increase in November, and the chances of one in December have risen to the mid 70%. And that was only down, I think it was 8 or 9% just a month ago, JD. So the rapid change that we have seen in rate expectations is going to act as a natural lift to Treasury bond yields. But the movement or the speed of the movement is a little more rapid than a lot of people had first anticipated, and certainly more rapid than would make them comfortable. So those increases, I think, have to some degree tamed investor sentiment, which had logically been improving as a result of these better than expected earnings from the banks and from others. And therefore, I think that's why you're seeing that pause we are witnessing today in broader U.S. Equity markets.
Over on TheStreet.com this morning, Martin, you also wrote about more disruption in the global currency markets. It was something you were alluding to a short time ago. What is the latest there, and what drew your attention to that story earlier today?
Well, it was that psychological level for the Japanese yen, JD. It traded north of 150 against the US dollar. That's the weakest since 1990. And really what it does is extend not only the annual decline for the yen against the dollar to about 33%. But it has stoked once again speculation that the Japanese government will have to come in and potentially buy yen in order to prop it up. Typically, Japan wouldn't be too distressed by a weaker yen because it makes its exports more attractive. And exporting is, of course, one of the principal drivers of growth in the third largest economy in the world. But with inflation rising at the pace that it is, and the cost of living crisis beginning to bubble up in an economy that hasn't seen inflation for a number of decades now, it's incredibly important to keep the yen from sliding too much further because it increases imported energy costs, it increases imported food costs, and it's a significant burden to a population which has an extraordinarily high number of retirees, JD. In demographic terms, Japan is one of the oldest nations on earth. If I have the numbers correctly in mind, and I think I do because this is something I've read about in the past a number of occasions, it's only about 2 or 3 decades before more than half of the Japanese population will be retired. That's an extraordinary statistic that usually marks significant concern for all of the things that we're talking about. A government simply can't allow the slipping of a currency and the increase in imported food and energy prices into an economy where people aren't working anymore, where they're really only taking support from the government in terms of pensions and their own personal savings. So this is something that the Ministry of Finance is going to have to arrest very quickly, although their options are limited. They spent about $19 billion last month trying to support the yen, and it failed miserably. And of course, now we're testing these new lows. So it just goes to show how sort of isolated a lot of these problems are. Although with respect to Japan, the demographics issues make this a more intense situation for the government than it might otherwise be.
I do want to pivot here while I have you to talk a little Tesla, because you wrote about this quite a bit today as well. The company says it expects to miss its 2022 deliveries target. What are some other major headwinds you think weighing on the company right now? What else did we learn?
It was a pretty solid Q3 earnings data, it has to be said. They were they were about 5 or 6 cents ahead of the street forecast on their bottom line. And even though they missed on revenues by a little bit, they still posted a record number of sales, 21.5 billion, I think it was, and they had record third quarter deliveries. So I suppose that's not terribly surprising. But the fact that they did talk about having doubts with respect to meeting that full year delivery target was enough to take some steam out of the stock. They were at pains to explain that part of the reason that they won't meet that target is that there are transport issues which prevent cars that have already been sold from actually finding their way into the driveway of the purchaser. So if they don't meet the target at the end of the fourth quarter, those cars will simply flow out into delivery in the first quarter and everyone will be satisfied. So Elon Musk was talking about the fact that demand is simply not the issue right now, that there are constraints on the company's ability to meet it as a result of these supply chain disruptions. Now, investors aren't particularly convinced by that argument just now, and I think that's because we saw a relatively flat margin situation for the company. Their automotive profit margin, while really, really strong compared to its peers, was at 27.9%, exactly the same level it was at the end of the second quarter, and it's a little bit narrower than it was this time last year. So whilst it is exciting to see the demand and the meeting of that demand as a result of production increases, from a profit point of view, that demand has to be met with wider margins. And Tesla just isn't doing that at the moment. And they may not be able to do it until these supply chain disruptions work themselves out. And we simply aren't seeing that in the automotive industry at the very least.
Yeah, absolutely. The company reporting... or rather, I should say, the company is currently down 8%. Shares down now in this trading session on this Thursday, trading down right around 204. That's amazing to look at those numbers, because for those of us who covered Tesla stock for so many years, you remember back when it was relatively up in the 300s, the 400s, and even much higher, all-time high about 407 or so. So fascinating story there. We'll continue to follow. Okay, you want to do a little rapid fire here, Martin, with the time we got left? This is quite the show. I've thrown a lot at you today. And as always, you bob and weave through this laser field of questions that you never know are coming. Okay, let's hit this rapid fire here. First one up, IBM. Oh, I've wanted to talk about this. IBM earnings. What has the company's revenue on a roll? What did we learn?
Well, they've been increasing revenue now for 15 consecutive quarters, and that was one of the principal criticisms of the prior leadership of IBM, is that they simply weren't able to grow revenue as a result, even as a result of the expansion that we were seeing in cloud and software and everything else. But now IBM seems to have steadied the ship with respect to that. They bought a cloud computing group called Red Hat a couple of years ago. That's starting to bear fruit as well. So they grew across all of their business metrics with respect to infrastructure, consulting, hybrid cloud, and that was really impressive for IBM. Their margins are narrowing, though, and that is a bit of a concern for investors, particularly those, JD, focused on IBM's dividend. There's a group of companies called the Dividend Aristocrats, which have been increasing their dividend payments for 25 years or more, and IBM is a member of that list, and proudly so. The last thing they want to do is put that at risk. So they have been insistent on being able to meet their free cash flow target for 2022. They're going to have a really strong quarter in order to do it, because they don't want investors to think that the dividend will be at risk. I don't imagine that it is. I think it's simply too high a benchmark for IBM to toy with. But because margins are narrowing and free cash flow needs to really ramp up over the final months of the year, there are some headwinds to the performance that we're seeing for the stock. But ultimately, a beat on the top and bottom line and growth across all of the business divisions is not something we're seeing of late from IBM, and it was very much welcome news.
Yeah, of course, a few high-yield dividend aristocrats might be very appealing to a lot of people. That's a fascinating list and a great reference there. Okay, number two, what did we learn from AT&T's Q3 earnings? Pick up the phone. What do you got?
I had a boss a long time ago, JD, when I was a young whelp on the bond desk, who once told me that bland is good, but boring is better. You really want certainty with fixed income purchases. And I mentioned that with respect to AT&T because it's a different company now than it was this time last year. They've gotten rid of all their media assets, and they now want to be a plain vanilla telecoms. They want to bring people into the wireless division, bring people into the home internet division, and just take in the cash. It's not necessarily an exciting business, but it's a lucrative one. AT&T had better than expected earnings over the 3 months ending in September. They beat the street. I think they were at $2.65 per share. They boosted their full year profit guidance by about a nickel at the higher end. So that was all relatively good news, and it was built on the fact that they're adding more wireless subscribers. And they're doing it, JD, without raising prices. And I think that's really important. They talked about the potential for price hikes over the summertime when they noticed that people were maybe falling behind a little bit on their bills as a result of the broader, that not only the spike in inflation that we witnessed at the time, but the sort of slack that we were seeing in labor markets as well. They haven't raised prices, and I think that is a good sign with respect to them still being able to grow their subscriber base. It was up about 708,000. Some of that linked, of course, to the promotions that we all see when we watch sports related to the iPhones and things like that. But again, nonetheless, not the exciting, flashy media company that we used to know, but really just a straightforward, cash-generative telecom. And that transition has proved maybe better than some people had anticipated for AT&T, and the stock's getting a kick as a result.
Absolutely. Okay, third and finally here for a rapid fire week 7. How is it already week 7 of the NFL season?
I know, stop.
All right, We got New Orleans and Arizona. This is a Duke 'em out battle of the 2 and 4s. Who do you like?
The Cardinals shouldn't be 2 and 4, really, should they, JD? Like, they're so talented. And I would love to see Kyler Murray sort of unleashed in a way that allows him to do Patrick Mahomes-esque things without necessarily having to run circles around the backfield because his offensive line has gone for a sit-down or a cup of coffee in the middle of the play, or certainly so with teams. So I'm kind of rooting for the Cardinals because he's such an exciting player to watch. When you think about the talent level for someone like that, who had his pick of professional sports and could probably transition to baseball this afternoon if he chose so, you're just in awe of what they can do on the field. And so I'm always excited to watch him play. And it's always interesting to me the way that NFL football has changed that would allow a player at quarterback of that size to flourish. So as a result, I like the Cardinals.
If he is interested in popping over, I think the Yankees could use a little bit of help in the bullpen if he does want to get ready just in time for Game 2 in the Bronx. That could absolutely be necessary. Admittedly, I'm like many other people, I was up far too late watching these games. You find yourself tuned into the World Series as well. We talked a little bit about it yesterday.
I did. I watched a little, not as much, largely because of what you just described. It's just a little bit too late for me. But, and you tell me if I'm wrong about this, JD. I don't think that I've seen players put a bat to balls pitched by Verlander to the degree that they did last night anytime in the past. He's usually so lights out when he's pitching at his best. I was just surprised to see the ball in play as much as it was last night in the bit that I watched. And that's just not something I'm used to seeing from such an excellent pitcher like him.
You often don't get his first game against Seattle was a bit of an ugly start, though uncharacteristically so. Though that was the only other start he had in the playoffs before yesterday. So that's the only other thing that we had to go on. But as we frequently say, especially for the Yankees, you live by the long ball, you might end up dying by the long ball. And I'm a little nervous for if the big bats continue to show up here. But we should have a great football
especially
game.
In these
Arizona
short,
Cardinals.
Yeah, in a short
exactly.
sample, you're absolutely right.
Yeah, absolutely. And by the way, to the point about football here, the Cardinals are 1.5-point favorites as well. Do you follow the lines for football? Yeah, you do. You follow lines and over-unders and all that?
A little bit, although like most of us, JD, I'm more focused on my fantasy team than the betting lines of the game because I find that it's a bit more broad and a bit more fun. But that line, it seems light to me. I don't know, but Vegas is so the way that they are able to crowdfund risk assumption and put it down into a single number of a betting line, I think is just fantastic. And that's why they are able to, everybody else half win, half lose, and Vegas never does.
Risk assumption. That's what I see. See, you and I one day we're just going to do a full sports wagering thing because I think the whole sports wagering conversation can be elevated with more terms like that. I appreciate the conversation. Should be a few good games tonight. We'll see if the Yankees can get on the board with one at the Bronx. The great Martin Baccardax, thank you especially for rolling with a lot of big breaking news because you always provide valuable context and perspective to make sure we understand what's going on. Martin, thanks a lot.
Thanks, JD.
You got it, man. All right, that's going to do it for the Market Open here from the floor of the NYSE. Stick with TheStreet.com for more on these and all of the major market stories that matter to you. We'll see you tomorrow.